Hello, thank you for joining us today on the Profit Scale Thrive podcast, where we guide attorneys to overflowing profits, scaled growth, and thriving lives. I am your host, Kelly Brubaker. We have a secret though. This is a special place because we don't work with every law firm owner. We support the solo attorneys who are also single parents because we know the special challenges you face, and we know the business advice out there is not always practical for you and your firm. Each week, we will talk about things that will give you the insight you need to stop feeling overwhelmed, to gain back your confidence, and to finally enjoy your law firm and your life again. Hello, and thanks for joining me today for podcast episode number 3. Welcome back, or for those who don't know me yet, my name is Kelly Brubaker. I'm a CPA and a business coach who supports solo attorneys who are single parents. I'm also a certified Profit First professional, which means I help my clients implement the cash management system presented in the book Profit First, written by Mike Michalowicz. So today I want to talk about trust accounting. While I'm grateful to not know anyone personally who has been disbarred for impropriety with their trust account, I know how common trust account issues are, and I'd like to squash this issue today once and for all. So let's dive in. So what's the purpose? Attorney trust accounts exist to protect clients' money by separating the client money from the law firm's money to ensure professional conduct. Most, but not all, state bars require firms to have a trust account, whether you use it or not. It is every lawyer's professional responsibility to manage their trust accounts with the utmost good faith. Failure could put you at risk for being disbarred. So what does it mean to have a trust account? Actually, you end up with 2 new general ledger accounts in your books. So you have an IOLTA account and a trust liability account. The IOLTA account, which means interest on lawyer trust accounts, is a specific type of bank account. It's similar to a checking account. The account is interest earning, and all interest earned is automatically transferred to your state IOLTA board each month to fund a variety of programs, stuff like legal aid for low-income citizens and law school scholarships. The trust liability account is your firm's record of who is owed money that is sitting in the IOLTA bank account at the bank. So on your firm's financials, your balance sheet, you're going to see the IOLTA will be a new asset in your banking section, and the trust liability will be a new liability that's typically under your accounts payable account. So here's the big question. Are you in balance or are you out of balance? So there's a few questions to ask at any given moment of time, and this is typically done at the end of every month through the normal bookkeeping process. So 3 questions, and you have to answer yes to all of these to be in balance. It's not a 1 or 2, you're good. All 3 of these you have to answer yes to all 3 of these to be in balance. So at a specific moment in time, question number 1, in your bookkeeping system, does the balance appearing on your general ledger or your balance sheet for your IOLTA account agree to the penny to the trust liability account? Yes or no? If yes, you're good. If no, you're in trouble. Number 2, when you add up the individual balances you're holding on a per client or per matter basis, does that amount agree to the penny to the trust liability account on your general ledger? If yes, you're good. If no, you're in trouble. And the last question, does your IOLTA balance in your books reconcile to the IOLTA balance per the bank? Now notice the first 2 questions, I specifically said that those comparisons need to agree to the penny, no exceptions. They either agree or they don't. But this last one, this is your standard bank reconciliation that gets done on your bank accounts every month end. So you can have exceptions because there are going to be things that your books have transactions posted that have not yet cleared the bank. You issued a check, the check it's in the mail, not been cashed. So your books know that transaction, your bank does not. So those will be different balances, but you can reconcile. You know what that difference is. You can account for it. So if you can answer all three of these questions as yes, then you're in balance. So, right? We can celebrate, because what a wonderful world it is when you can pass these three tests. Everything's good. But what if you couldn't answer yes to all three of those questions? So let's go back to the first question, which was, in your bookkeeping system, does the balance appearing on your general ledger or balance sheet for your IOLTA account agree to the penny to the trust liability account? So if you answered no here, if the balance doesn't agree, if these two balances don't agree, this is usually caused by one of these two following items. Either a client trust deposit was posted correctly to the trust liability account, but it was either posted, meaning the journal entry was wrong, or it was physically deposited to the wrong bank account. Okay, that's the first possible issue. Second possible issue, it could be that an expense paid on behalf of a client was correctly paid from the IOLTA account, but posted as the firm's expense in your books when it should have been a reduction in the trust liability balance. Now, these are just two reasons. If I sat and tried to explain all the variety of reasons I've seen this specific question be out of balance, we would be here all day. These are the two most common, okay? So now what about my second question, which was, when you add up the individual balances that you're holding on a per client or per matter basis, does that amount agree to the penny to the trust liability account on your general ledger? So if the sum of what you're holding on behalf of clients does not agree, this is usually caused because, again, if I listed everything that I've ever seen, we would be here all day. So usually an expense was paid or a trust deposit received, was correctly posted on your general ledger, but the detailed report was not correctly updated. That's the most common, but this doesn't cover every exception, just the most common. And where I see this the most common is when a firm does not use legal specific accounting software and instead tries to keep the detail for their trust account in either a Google Sheet or an Excel file. Again, this is just the most common exception. So what about the fix? I'm a handy chick. I tend to do a lot of things myself that I should delegate, but that's usually because I should delegate because of time, not ability. But this is not one of these situations. Whether you can fix an out of balance situation on your own is a function of ability. Once you're out of balance, I rarely see a quick fix on this. I guarantee it will take you hours, if not weeks, to figure out where the issues are. And trust me, there will be many different issues. But as bad as the investigation phase of this is, the fix is actually worse. The problem to fix each issue is you need to be extremely careful to correct the right general ledger accounts without making the situation worse. For example, if your detailed records do not add up to the total per the liability on your general ledger, this could be that your detailed records need to be updated with no journal entries that need to be posted to your books. But if you don't know whether you need to post a journal entry to your books or to update your detailed records, or possibly both, you're in over your head. So if you're confident that you can tackle each item one by one and that you have the time to stick with it, then roll up your sleeves and get to it. Be sure to keep records of what you're doing in case you're audited in the future. If you have a bookkeeper who created this mess, I recommend having a meeting with him or her to see if they understand what went wrong and if they can understand how to fix it and how it can be prevented in the future. I'm not one to be dramatic, but at any point, if your trust becomes out of balance, you have exposure. Your license to practice is on the line here. If you have any doubts with your firm's process or your bookkeeper, this is a sign to revamp your trust process or replace your bookkeeper immediately.
Now it's time for our listener's question of the week. Today's question is from William. I keep hearing from other attorneys how I need to stop doing my bookkeeping and hire an accountant. I know it's the right decision so I can grow my firm, but I'm nervous for a lot of reasons. Here are my top issues. First, I don't want to give access to my financial information to someone else. There are several concerns here. Second, I don't know how to let go and still stay on top of my numbers. And third, right now, I don't know if I can afford it. How can I get past this and move forward? First, I want to congratulate you, William, because tackling this conundrum is critical to break through and reach your growth goals. But buckle up because this is going to be a long answer. Before I address your specific concerns, I want to make sure you understand a few key benefits of having an accountant. Having a part-time bookkeeper or accountant will free up your time to hopefully let you focus on billable client work. To convert this into numbers, if you are spending 6 hours a week on bookkeeping, an experienced bookkeeper will be more efficient and may only need 3 to 4 hours per week to complete the same tasks. I don't know your location for accurate rates, but for easy math, let's say you pay a bookkeeper $100 per hour at 4 hours per week, and you're able to work on billable work to fill up your previous time spent on your books. If your billable rate is $300 per hour, then you will increase your bottom line net profit by $1,400 per week, or $72,800 per year. The math on that is your 6 hours you're no longer spending on bookkeeping at $300 is an increase of $1,800 in billable time per week. Subtract $400 from that, which is what you would be paying a bookkeeper for 4 hours at $100 per week. So $1,800 in new revenue minus $400 in a new expense is a net increase of $1,400 per week, multiplied by 52 weeks, and that's $72,800 annually. Now, this is math I love. Something to keep in mind is that a bookkeeper is a trained professional, someone you will not need to handhold. There will be some time needed to transition information because nobody's walking into your firm and will instantly know your specifics. But once you get them up to speed on your details, they will be able to do their work with limited involvement from you. Here's another thing. While you may average 6 hours a week on your books, are you consistent with your time and with your bookkeeping tasks? Where I'm heading with this is really about being consistent with your two main components of cash flow, literally the ins and outs of cash. A bookkeeper who works consistent days for you will be able to routinely bill clients on a consistent basis to help you with your inflow and routinely pay what you owe to vendors on a consistent basis to help with your outflow. Being off kilter with timing on inflow or outflow of your cash can put an unnecessary strain on your bank account. Okay, now for your specific concerns. Regarding access to your financial accounts, let me assure you that you will maintain control over what your bookkeeper can access. Some of this will depend on access controls available from your bank and from your bookkeeping software. Be sure to weigh that the more online access you can give a bookkeeper, then they can be more efficient and demand less of your time. In last week's episode number 2, I spoke about Relay Financial. The features they offer with account access and restrictions may alleviate much of your concern, but most mainstream banks and credit unions will allow you to set up a bookkeeper with read-only access to specific bank accounts. You can restrict the bookkeeper's login to not allow the initiation of payment from your accounts completely or by a dollar limit. Some software will link your online activity to your books, so your bookkeeper rarely needs online access to your bank accounts. QuickBooks Online, for example, will download transactions from your bank every night and your account statements at month end for reconciliations. If you use QuickBooks Online to pay bills, you can restrict payment approvals based on user logins too. Let me also add that a bookkeeper that you hire should have professional liability insurance. So I hope that helps with creating a foundation of trust. And in my experience, bookkeepers are professionals, similar to what happens in Vegas, right? Rest assured that your information is kept confidential. Bookkeepers are focused on posting your transactions in order to wrap up your work so that they can move on to their next client of the day. As for your concern about how to stay on top of your numbers, yet retaining control, determine what your key metrics are. Talk to your bookkeeper about your concerns and ask him or her to update a dashboard every week with your key metrics. Depending on your bookkeeping software and the key metrics you choose to monitor, your bookkeeper may not even need to do anything for you. You may just need to log into your software once a week to see your current stats. QuickBooks has a dashboard that has limited customization to it. Other applications do too. Whether your bookkeeping application will do this for you automatically or your bookkeeper needs to update a report for you, it then becomes a matter of scheduling 15 minutes a week to do your review and ask your bookkeeper questions for things you don't understand. As for being able to afford it, go back to my first comment after your question. Update the numbers I used in my illustration with your actual billable rate, hours you're spending on bookkeeping, and get some quotes from a few bookkeepers. Keep in mind that so many bookkeepers can work remotely that they're not limited to just being local to you. In fact, specifically for law firms, I highly recommend finding a bookkeeper who's experienced specifically with law firms because of the complexity that comes with your IOLTA and trust accounting. A slip up in your trust accounting could lead to serious consequences for you and your firm, and it may take hiring a bookkeeper who is fully remote outside of your local area to find the right person to protect your trust accounts. Thanks, William, for your question. If you would like to submit a question for a future episode, please send an email to podcast@profitscalethrive.com. And know by sending an email to us, you will not be added to an email distribution list. There will not be a phone call from us, nor will there be a sales pitch. We follow the golden rule, treat others how you wish to be treated. Today's quote is from Carol Burnett. "Only I can change my life. No one can do it for me." My final thoughts for today. Truthfully, I know going into today's episode, you already knew how critical your trust accounting is, but I'm not sure how many attorneys know how to tell when they're out of balance. I hope the 3 key questions we discussed made sense to you. If you have a bookkeeper, they should be answering these 3 questions every month as part of their normal month-end process. They just need to show you that they've done this check. If you have any questions about trust accounting, I'm happy to answer them. Send me an email. While it is not part of my typical services, I will occasionally work with law firms to review and fix their trust account issues. For projects that I'm unable to work on due to prior commitments, I do have a short list of trusted accountants and bookkeepers I know who are experienced with trust accounting for law firms that I'm happy to recommend. I hope that if William's question resonates with you, that you seriously consider bringing a bookkeeper or accountant into your firm immediately. I have spoken to so many firms who try to do their bookkeeping on their own, Either a partner does it or it's delegated to the receptionist or a paralegal. But between you and I, delegating to an employee who is not a bookkeeper only works out in the long term if the employee is a unicorn. If you have any questions about today's episode, feel free to comment if you're watching on YouTube or send me an email at podcast@profitscalethrive.com. If you know someone who might need to hear this information, please share this episode with them. Or if you are on YouTube, tag them below. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks and have an amazing day.